Let's get to your money. If we learned anything about March Madness, it's that you should not rely on predictions all the time. While anyone has a chance to get a perfect bracket completely right, there are odds. 1 in 9.2 quintillion, actually, according to the NCAA. Now, thankfully, my March Madness bracket was 1 nanofactor of the Brad Equity Partners 2024 financial planning, because as you can see here, bad predictions everywhere and a lot of emotional picks as well. Letting predictions sway your investment decisions could also lead you astray. Economic predictions are all the rage, and we'll see that play out during Friday's jobs report, a key input in the Fed's decision making. As investors look for more clarity on the health of the labor market, for more on this, we're joined by Scott Inman, who is the financial advisor at GenWealth and host of Get Ready for the Future show. Scott, great to have you here with us today. As we think about prediction pitfalls that some people become too reliant on, what is the number one out there that you see time and time again?
Well, first of all, I'm going to admit to you that my bracket was in the trash after week 1. I didn't even get into the second round and still have a chance. Didn't get one Final Four team right. When you think about economic predictions, I do love the analogy you drew to trying to predict a perfect bracket. I'm not here to rain on those predictions. I think they are valuable to some degree. We follow economists, we read commentary, we look at the economic data, but it is just a snapshot when you look at all that data of where we currently are. And I think as complex as trying to predict where we're going is, it is very much a fool's errand to really build an investment strategy around those predictions because they're often wrong.
Some of those predictions are very imminent telling or imminent facing as well here. For people who are trying to position their investment strategy, their portfolio strategy, their retirement planning, or just financial future around things that are far further off, how far out should and could they be looking, and how do they kind of stagger what those timelines look like?
Yeah, I think anyone who is investing in equities should have a long-term strategy. And at GenWealth, we talk to our clients all the time about that long-term strategy should be 10 years and longer. You should not really be looking at 12-month predictions and making drastic change to your investment strategy. Certainly, asset allocation, sector rotation, some diversifying moves can be called for, but to bail out of the market entirely because you think it's about to go down, or get into the market at a high, which is what a lot of people do, can be, as we talked about, a fool's errand. If you look at that, 3 reasons to avoid economic predictions, we already talked about they're often wrong, but it can cause you to do the wrong thing at the wrong time for the wrong reason. If you look at COVID, for example, and that's our most recent example of a significant downturn. Certainly that was a dire economic situation and the market plummeted, and that caused a lot of people to jump ship from the stock market. But that was in March of 2020. We just recently passed the 4-year anniversary of the pandemic low, and the S&P 500 is up 133% cumulatively and 25% annually since that time. So now granted, that's a 4-year time frame. Some people may have jumped back in at some point, but they missed a lot of the ride back up if they waited too long. Technology was resilient during the shutdown when we were all staying at home, and the market rebounded quickly. That was not something you were hearing in the economic predictions.
Of course, now past prediction does not always, or past performance does not always equal the future success rate here. So, I mean, when we think about, and this kind of draws back to my own bracket as we kicked off this conversation, a lot of this comes back to emotion. How do you advise those out there to remove emotion from their own planning?
Yeah, I think that's a big key, and that really is what drives this. We as humans, we want to be able to control our future, and that's really what we're talking about here, right? Our clients are seeking financial independence. They are wanting to control what they can control, and they want to really begin to decipher what's going to happen in the future as part of that. We can't do it. But our emotions, when we get fearful when the market's down, or we get overly exuberant when the market is up, can cause us to make bad decisions. So in terms of answering your question, how do you control those emotions? We really believe working with a financial advisor is one of the best ways to do that. And here's why. If you have a good financial advisor, he's objective. He or she is objective, first of all. They are not emotionally tied to your money like you are. You should be emotionally tied to your money. I'm emotionally tied to my own personal finances. but I'm not to my clients, and I have an objective viewpoint, and that can help in the behavioral things that come up that can keep you from making those bad decisions.
When we think about where there's so much kind of prediction coming in, whether that's in a 30-second to minute-long clip on social media, or whether that's one of the talking heads that, hey, even I talk to from time to time, how can people spot where there are there is credit to the predictions that are coming forward? What are the kind of the baseline guidance that they should be looking for within that, and the depth of that prediction, if you will?
Yeah, I think generally the talking heads, the 30-second clips, if they are an unbiased economist that has really tried to create their own models and make predictions based on data, that's a sound prediction. I still wouldn't put 100% of my investment strategy behind that, but I do think where you can look for problems is, well, let's give you an example. When you get into a down market, people are fearful of a recession. What do you see pop up more and more often? Ads for buying gold, right? That's the solution here, that the market's going to go off the deep end, but you have to go, well, why are they telling me that the market's going to go off the deep end? Are they trying to sell me something? Are they trying to sell me a product? Do they have my best interest at heart here? Are they looking out for me? I think that's one thing I would do to self-evaluate for sure. But I think coming back to our original point, spotting whether it is a good thing to follow or a bad thing to follow is the first step, but never put your full investment strategy behind anything that's predicting a short time frame in the market. You know, I talk about, I use an analogy to meteorologists. I used to work on television. I was a television news broadcaster, and I worked with meteorologists, so I can say this. You know, when they do the forecast for tomorrow, they've got a pretty good idea of what might happen tomorrow because we're that close to it, right? Data might be coming out. Sure. We might be able to show some things about inflation. We might be able to show something about the jobs report, what the Fed might do. But when you get to the 7-day forecast, you know, like right now, if we looked at what the forecast was for next Tuesday in Central Arkansas, it might say 75 degrees. But by the time we get there, I'm going to bet it changes. It's going to fluctuate one way or the other. And I think the same is true for economic predictions. You know, the shorter term about as the time that data comes out, there may be a good estimation of what's going to happen. But if you go much farther out, if you say what's going to happen in the next 12 months, like Bloomberg did in October of 2022 and said there's a 100% chance of recession in 2023. Didn't happen, and they weren't alone. I'm not singling out Bloomberg. There were a lot of people saying there was almost guaranteed to be a recession in 2023 over that 12-month period, and they turned out to be wrong. So longer-term predictions like that are very difficult to come true.
Scott Inman, financial advisor over at GenWealth and host of the Get Ready for the Future show. Scott, thanks so much for taking the time, kicking off today's show with us.
Thank you for having us.